Well, hello, everybody. It is cold out there, but hopefully it's warm inside and it's alternative power that you're wanting to learn about. Then you have joined the right webinar because we are talking about the EV economy in this webinar, which is hosted by Small Cap Investor and Master Investor. My name is Sarah Lowther, and over the next 2 hours, I'll be joined by several speakers from the following institutions: Hybridon, Pensana, GreenRoc Mining, Equipmake, Trident, Royalties, and Cornish Metals. Now, one of our companies presenting today told investors just this morning, we firmly believe that the world is on an irreversible path to far greater electrification, and the transport sector is front and center of that. So today's format, well, the format is 15 minutes for presentations and questions. So 15 minutes in total for each presenter. Now, if there's no time for questions, then please email them to this address, which you are going to see now in the chat function, the Q&A function. There it is. I think it's sophie@masterinvestor.co.uk. A lot of superb intelligence to share with you up till approximately 2:45. Now, halfway, there will be a 10-minute comfort break. Right, first up, to set the scene and provide the wider context for our webinar, I'm delighted to be joined by Emily Lear, the Associate Director of Research at corporate broker Hybridon. A very warm welcome.
Hi, thanks for taking the time to join us, and it's being a privilege to be here as the first speaker in the panel. We hope our talk will help the audience to understand the big picture and help to set a scene for the whole webinar. I think first of all, a brief introduction to our company. We're Hybridon. We're based in the City of London, very passionate about London capital market. We provide strategic corporate finance and corporate broking for private and listed company. We are specialists in small cap and sector agnostic. Next slide, please. So here is a range of service we provide. We provide corporate finance advice, advisory, corporate broking, equity sales service, and I myself chair the equity research function. We help growth company and listed company on member and Equus growth market to access institutional investors. Next slide, please. Okay, we are actually, although we are sector agnostic, we help company in all sectors, but we published a sector piece last year. We issued 2 sector pieces last year. And the reason we're doing this is that we think a thematic approach will help investor to connect the dots when they want to generate ideas in a center on specific topic. And we also want to write about the sector we think is very critical to the UK, very pertinent to the UK economy, and where you see growth opportunities especially. And our sector research is actually industry research. So even though the sector piece we wrote about last year on critical minerals May last year, but all the key issues remain the same. And I think we hope our audience, when you have time, go to our website, you can download the report. So my talk today will be centered on the sector piece we published last year on mining, virgin mining and urban mining, which means recycling of lithium. And the focus is on battery recycling for electric vehicles. Next slide, please. I think it's actually quite important for audience to have this mind map established. Traditional EV economy is very one way. You start from mining companies who mine all the critical mineral like lithium, nickel, cobalt, copper from the ground, from the soil, and then they ship to chemical plants, smeltering and refinery plant. And then those elements, mineral, go to battery material producers. And the battery material we focus on in the report is cathodes. And the reason for this focus because cathode is actually the active material, active ingredients in the battery cell. And that's also where all the critical minerals are sitting in: lithium, nickel, and cobalt. And all this, once the minerals are produced into cathodes, they're shipped into gigafactory where cells are being produced. And once the cells have been produced and then produced into cell and then into packs of different shapes, and then go to EV companies, car manufacturers. So it's very one way from the upstream to downstream. And other than this, I think there's a very key number for everybody to remember is that battery packs typically account for 40%, sometimes more, of the value and the weight of electric vehicle. So this is quite important because when we talk about EV supply chain, a lot of discussions on battery, because the battery consists of 40%, sometimes 50% of the weight and value of a car. And the one way EV economy is in the process of transforming into a very closed loop two-way, because of two reasons actually. First of all, when we talk about the global supply chain, one key issue is resilience. So it'd be good to see a few hubs globally for the production from upstream to downstream. So one thing was, I think one hub is US and Japan for the car industry, Asia. EU has a very strong car industry, and UK actually also has a very strong car industry. So hopefully UK can play a role in this process. And secondly, when you have a different hubs globally, each hub can, if all the supply is vertically concentrated in one region, it will save on transportation costs and actually reduce carbon footprint. And another driver for this is that market-wise, the first generation of electric vehicle, Tesla, 2012, first Model S, those EV are retiring. So there's a need for battery recycling from those cars. And it's actually also very important to recycle the material from cathode because they're actually very valuable. And to close the loop, this is why we have to have a closed loop two-way EV economy. Next slide, please. So I think this picture is very important because when you put into this urban mining, which is recycling, urban mining, when urban miners, recycler, want to recycle battery, there are a few sources battery cell they can get. And first is from gigafactory, because something like 60% of the cell in the cell factory are defect or not good enough. There's always some process problem, and those scraps should be recycled. And these are very good feedstock because you know the chemistry and kind of can predict the volume. So gigafactory is very important in this closed loop process. And also a recycler also get battery for recycling from car maker when they have a recall for safety reasons. And sometimes we hear that from different car maker when they have to recall cars. Those battery are also in relatively good shape and it should be recycled, at least repurposed. And of course, and then there's the retired cars on the streets. When you buy a car, electric car for 10 years and the battery gets wasted and you have to replace the battery and replace the car. So all the car waste battery should be recycled as well. So there are actually three resources battery for recycling from gigafactory, EV car maker, and car owners. And all the study globally, to talk about industry scale recycler, the initial feedstock, actually, the most of it is from gigafactory and EV car makers, because they actually give you a big volume and predictability, a quality and quantity of feedstock. So this is quite important. So when we talk about EV circular economy in the UK, it'd be good to, it's actually quite important for UK to have our own gigafactory and our electric vehicle manufacturer here. And because today we know there's 1 million cars sold EV running around in the street in this country. So that's actually one important concept to have is the source of a feedstock for battery recyclers. And the reason we have to recycle battery because two important regulatory drivers. And first of all, there's EU has a very important battery directive, and it's about accumulator and waste battery management. This legislation is likely to be enforced in 2025. It has a very comprehensive set of rules on how much material should be recycled, and has a very detailed timetable. So that's the first thing. And the second thing, it's very relevant to the UK, is because UK-EU has a free trade agreement, which is under the umbrella called Rule of Origin. That's tying to this EU battery directive. In the Rule of Origin, the final outcome is something like 50% the content in the car has to be EU, UK manufactured to be qualified for free trade agreement under this. And EU actually is a very important market for UK cars. Something like 80% of cars made in the UK are exported. And among that, 60% are shipped to the EU. So it's actually quite important for the UK car manufacturer industry for us to qualify this. And to qualify this, apparently, because the 40% number I previously mentioned in the previous slide, to qualify this rule of origin for tariff-free, we have to have a battery locally made in the UK or in the EU. So I think that's very important. And the second thing is for the ecosystem of listed companies, small cap, we see a revival of mining exploration activities and development in the EU and the UK because of this. If we use a Paris Agreement 2015 as a cutoff point, before that year, there's no established identified resources in the EU, even the UK. But now EU and UK altogether accounted for 5% of global identified resources in lithium. They're not reserves yet, but definitely a revival of the mining exploration activities for those critical minerals. And another thing very important to remember is that, as I mentioned, Gigafactory and EU car making is actually quite important, and there should be government support and institutional and retail investor support into this ecosystem. And we, in the small cap space, we also see opportunities in chemical plants and urban, recycling. And there are actually a few companies we mentioned in our report. And there will be other companies, to come, I think, we believe, going forward. So hopefully this presentation will help audience to establish a mind map for the following presentation and following discussion. Thank you. Next slide. This is my contact details. So any question, feel free to email us and we will try our best to accommodate. Thank you.
Thank you very much indeed, Emily. If I can just start my video. There you go. Not that you really need to see me. Thank you very much for that. So I'm just wondering, what are the, taking your presentation into consideration, what are the key issues for investors to think about when they wish to start investing in the EV economy?
I think first you have to pick the supply chain activity you feel very comfortable with. And the economics have to make sense long-term wise. And I think for example, if you go for smaller cap, maybe mechanical recycling is a good place to start because the capex is relatively light compared to the whole vertical chemical recycling, vertically integrated. So basically, the mechanical process is to process waste battery into carbon black. That can be done in small regionally. We collect car or waste car from England, for example. So that may be interesting to look at. But if you, for retail investor, you're looking for mid cap, there's a different economic you should look at as well. But if it's a very UK focused player, the UK and EU legislation, trade relationship, I think very important.
Tim, if we can just go back to the circular economy diagram, please,
Yes, that's actually a very important slide.
because John has said from the circular economy diagram,
Yes.
one moment, please, right there. Right, so John has said from the circular economy diagram, it looks like the chemical plants are critical as they take both virgin miners and recycle the feedstock.
Yes. Yes, that's true.
Okay, so Emily's in agreement there, but thanks for...
But sometimes, because a cell maker in Asia, especially Korea and Japan, they're very advanced. So they actually have a capability to recycle some of the feedstock from waste battery. So this is in general the case, but in reality, chemical plant process virgin mining could be very close to the mining sites. You see what I mean? And chemical plants very close to where the gigafactory is situated is most likely to take a lot of feedstock from urban miners versus recycle sources. So this is in principle true, but in reality, I think chemical plant really depend on where it is.
Understood. Now, you mentioned the word resilience.
Yes.
How fragmented is the EV economy? You know, what needs to be done to make it more circular from mining to recycling? Will it need government support?
Yes, definitely. Yes, yes. I think government support is very critical because today 90% battery cells are made in China. And I think 90% of smeltering capability is in China. And I think I read, actually, it was mentioned in our small cap fees yesterday. China actually banned the export of a graphite, which is very important for anode. It's another battery material. So to kind of de-risk and to make the supply chain more resilient, because I think COVID gave us a very bitter lesson on, something happened in one region will cause another region some problem. The supply chain activity is very concentrated. So the key for all this EU battery directive is to really decentralize that supply chain, to make basically to have a few hubs globally, and each hub can have a self-sustaining ecosystem to support that. But that's actually easier said than done because rule of origin and EU battery directive, their legislation both been delayed for at least 2 years and 1 year. And the ban of a sale of a diesel and a petrol vehicle also delayed for 5 years in the UK from 2030 to 2035. And the main reason for that is because the supply chain is not ready yet.
Understood. Emily, we're going to have to stop it there. But to access Emily's research, go to the Hybridon website, and you and I have discussed this in great detail, I think last year, and you can go on the Master Investor YouTube channel and see Emily and I talk about it at quite a high level. So Emily, thank you very much indeed.
Thank you.
Okay, to our next, in fact, our first company, it is Pensana. It's developing one of the world's largest rare earth deposits. It listed on the London Stock Exchange's main market just 4 years ago, 2020. Its market cap today is £58 million. I'm delighted to introduce the chairman, Paul Atherley. Very good to see you, Paul.
Good to see you, Sarah. Thank you. Tim, I wonder if we could have the first slide, please. Just while Tim's bringing up the first slide, we are, as Sarah said, we're looking to develop one of the world's largest undeveloped rare earth projects. And Emily mentioned the battery EV supply chain. We are not quite part of that. We're part of the bit that makes cars go. We're part of the axial motor supply chain. So what makes a Tesla 3 Sport nearly as fast as Lewis Hamilton's Mercedes off the grid line is not just the EV battery, but it's actual these ultra powerful axial motors, and what makes them super powerful are these rare earth magnets, and we're part of that rare earth magnet supply chain. Next slide, please, Tim. As Sarah mentioned, we've got a market capitalization of £58 million. We are unusual that we are funded by our major shareholders. So the Angolan Sovereign Wealth Fund owns 26%. They've put in $50 million into the company so far. M&G put in 22 million, and even more unusually, the chairman, myself, I put in $1 million, much to the concern of my daughter. Next slide, please, Tim. As Emily has mentioned, and as somebody's mentioned previously, we're on an irreversible path to far greater electrification in the transport systems, and that's echoed by the IEA studies that we're going to have a tenfold increase in EVs, and that's going to translate into a 400% increase in demand for rare earths, and that's the market that we're addressing. Next slide, please. And just to summarize our position is we're a company that's delivering into, this is the biggest energy transition in history, and a 7.5% compound average growth rate of the metals and magnets that go into electric vehicles, offshore wind. We own one of only 3 undeveloped rare earth deposits that have more than 100,000 tons of NdPr. We're globally significant at 5% of annual production, and we've managed to engineer the project so the upfront capital cost is $200 million, which is one of the lowest amongst this peer group. And as I mentioned at the outset, we're actually financing at the moment. So we have 3 financiers. That is FSDA, the Angolan Sovereign Wealth Fund. They're our biggest shareholder. ABSA, a large bank from South Africa, and a number of African multilateral agencies who are working with us. And they're all financing at the subsidiary level. So we're not looking to finance at the Pensana level. We're looking to finance at the asset level. And then separately from that, as an event subsequent to the financing of the mine, we are looking to develop the Salt End, a facility at Salt End, the Salt End Chemicals Park in Humber in the Freeport, that'll take these rare earths, separate them, and put us on the supply chain all the way down to magnets. Next slide, please. The mine itself is located in Angola in West Africa. It's super high grade. It's got a 20-year mine life. It's only 30 meters deep, and it has the advantage of being connected to hydroelectric power, close to a major railway line, and plenty of available water. Next slide, please. Angola itself is becoming the go-to destination for mining investment at the moment. It's got 40 years of virtually no exploration. It's got an untapped critical minerals endowment. It's got exceptional infrastructure, a rail, hydro, port, and a highly supported government. So it's not surprising you see companies like Anglo American, De Beers, and more recently Ivanhoe. Robert Friedland has entered the country. Next slide, please. The mine itself is located very, very close to the Longondra railway station. We are, as I mentioned, the upfront capital cost of $200 million, $100 million deferred to year through. And at full production, we'll produce around 40,000 tons of a product called an MREC, which is a mixed rare earth carbonate. And within that mixed rare earth carbonate contains 4,500 tons of NdPr, which is about 5% of world annual production. Next slide, please. What makes the projects, one of the reasons why the project is low capital cost and a relatively short delivery time is that it's modular. So we're having each of these circuits manufactured off-site and then brought to site and basically assembled on site. So not quite an IKEA plant, but that's that idea. And then each one of these circuits, if you take the flotation circuit, for instance, they have been extensively pilot tested in laboratories in Australia. So thoroughly tested circuit, modular, and on site, basically just bolted together. Next slide, please. And the companies that are doing this are specialists in their MCC or our project management team, but ADP and ProProcess, these are teams that are specialists in modular construction. So you can see the truck on the right-hand side there that contains a bit of kit that'll get bolted together and turned into one of those circuits. Next slide, please. And we're well underway. The earthworks are well advanced. We've completed a 4.5 kilometer road upgrade to the station from the mine, completed power lines, and what you're seeing here are the foundations for a 350-man personnel camp that's currently being fabricated in Johannesburg and will be brought to site and put on these footings shortly. Next slide, please. The timeline is we're well into it. We'll be doing these earthworks and pre-construction activities for the next couple of months. And then from May onwards, we're into the main construction, which is around 12 months. And then we're into commissioning the middle of next year. So we're aiming to be in full production from January 26 onwards. Next slide, please. We recently had a visit from the full board of the Angolan Sovereign Wealth Fund. It was great to host Chairman Armando Manuel to site, and very pleased to say they were delighted with progress on site. Next slide, please. Just to give you a snapshot of just the mine and the processing facility is obviously we're dependent on what future commodity prices are going to be. So we've gone to Adamas Intelligence, which is one of the more highly regarded forecasting agencies, and chosen one of the investment banks in London, taken their forecasts and run the numbers through our model. And you can see there that whether you take the lower case, the investment bank, their forecast and NPV would be $600 million with very, very good IRR and very strong cash flow. And if you take the base case of Adamas, then it's we're talking about a valuation of over $1 billion US. Next slide, please. Tim George, our CEO, was in Luanda recently. He met with Chairman Armando, and very pleased that the Angolan Sovereign Wealth Fund is providing us with a $15 million loan facility to keep the momentum going on site whilst we're financing. The financing itself will be FSDA and a Pan-African multilateral development organization. They're looking to put $80 million worth of equity into the subsidiary level, basically the asset level for the company. And then the debt, the $120 million of debt, is being arranged by Absa Bank, and together with export credit guarantees from ECIC and debt participation from Pan-African Multilateral, we aim to have the whole $200 million in place and announced hopefully in the next few weeks, and hope to make the announcement on that shortly. Next slide, please. The offtake's really interesting. We're one of the few mines in the world that's going to come on stream in the next few years. We are looking to offer a high value, radionuclide-free MREC product available for export. We've had huge interest in the product, and we've executed a letter of intent for the offtake for 100% of stage one. So we've got a lot of demand for the product. We're going through qualification and I hope to have these agreements finalized through Q1. And what these companies are looking for, they're looking for mine-to-magnet transparency. So we've heard lots of stories about concerns about rare earths coming from places like Myanmar and the ecocide and environmental disasters associated with that. They're also looking for an ultra low embedded carbon product. So clearly, if we're using hydroelectric power, we've got low embedded carbon. Diversifying their supply, that's important for them, and obviously competitive pricing. Next slide, please. So the mining and the processing is step one for us of a four-stage process. Step one basically gets us going with the mining, producing a mixed rare earth carbonate. Step two is at the Saltend Chemical Park in the UK. Those of you who know it's the ex-BP Chemicals Park in the Humber Freeport, and that'll separate those rare earths into oxides. And then we are looking to go one step further to metallization, turn that oxide into a metal using hydroelectric power from the Dogger Bank offshore wind farm. And then we're teaming up with a magnet partner to see if we can then turn those into magnets. So upstream, what we're seeing today is step one of a four-stage project. Next slide, please. And to that, the UK government has recognized the importance of this supply chain. Emily mentioned it before. The UK needs to establish gigafactories. It also needs to establish a conversion of this current massive car industry in the UK, export driven, The UK makes internal combustion engines that needs to change from internal combustion engines to electric drive units, basically axial motors. And to that, we need a secure magnet metal supply chain. And the Secretary of State for Business very kindly has offered us a grant to help us move down that track. Next slide, please. And the Saltend Chemicals Park, those of you who know it in the Humber Freeport, is a very well-established chemicals park. As Emily mentioned in the previous presentation, chemical parks are incredibly important in the supply chains, whether it be for the lithium-ion battery supply chain or for magnet metals. These are complex chemical processes that are best done within these environments. In our case, ours is a world-class separation circuit that will produce 12,000 tons of rare earth oxides, 5% of the world's NdPr oxide, and along the way create 150 full-time jobs in the UK. Next slide, please. Recently had a delegation from our major shareholders, M&G, a whole bunch of government departments and local stakeholders, and all showing huge interest in the developments at Saltend. Next slide, please. And very pleased that William Izard, our Chief Commercial Officer, signed a deal with Chris Turner from the Yorkshire Energy Park just across the road from Saltend, which basically says that if we can produce a rare earth oxide at Saltend, we can take it across the road to the Yorkshire Energy Park, hook into the connections for offshore wind, and then convert those oxides into a metal that we can then work with our magnet partners to turn into magnets. Next slide. And again, Emily mentioned that the UK is a big exporter to the European markets, not just of cars, it's also of hopefully electric drive units. So aiming to produce 2 to 3 million EDUs to the European market by 2030. And it's important that to achieve that, these OEMs need a supply chain. Next slide, please. And we're aiming to be part of that supply chain. So the UK government is already working on electrical grade steels, rotor stator manufacture, but needs the bit that we've got, which is to go from rare earth oxides into metals, into magnets, to go into those EDUs. So we're working closely with government and partners to help create that supply chain. Next slide, please. We announced that we were invited to join a partnership with Polestar. Polestar have created this moonshot Golf, the Polestar Zero, the first climate neutral car. And the way they're approaching it is they're saying all the raw materials that have got to go into their car have got to be zero carbon or as close to it as you can. So they looked at all the rare earth suppliers around the world, and we're very pleased that we were selected as the partner for the Polestar Zero climate neutral car project. So very, very exciting project to be involved with. Next slide, please. And then as Emily mentioned, urban recycling. Well, we're not urban, we're looking at urban recycling, we're thinking of a much larger scale. The world's biggest or second biggest offshore wind farm is called Dogger Bank. It's the one that will power us at Yorkshire Energy Park. It comprises a large number of Haliades X 260 meter high 14 megawatt turbines. When they reach the end of their life, they'll get taken down, taken apart, demagnetized. And the plan is to bring them to us, use the hydrogen produced by Equinor at the Humber to hydrogen to Humber project at Saltend, just happens to be at Saltend, and we can decrepitate those magnets and turn them back either into metal hydride or a metal oxide, and creating the circular economy. Next slide, please. We have a strong independent board and some very, very capable and talented people making all this happen whilst I can tell the story about it. Next slide, please. And then just in summary, as Sarah mentioned, we've been listed for 4 years. We've made huge progress, developed one of the world's largest undeveloped rare earth projects. It's one of only 3 with resource more than 100,000 tons of NdPr with a capital cost of less than around $200 million. We're looking to complete financing in the next little while. And if we achieve that, our only two competitors out there who are in production are MP Materials and Linus, and they have market capitalizations of 3 billion and 4 billion US dollars respectively. So we have a lot of headroom if we get this right. Sarah, I hope that was helpful.
Certainly was helpful, and there's lots of handshaking going on as well. So two very quick questions, because we are overrunning, just for the benefit of doubt. Salt End, is it ready? Does it need any refurbishment, any construction? That's one of Leonard's concerns.
Salt End site is fully approved. It's ready to go. We just need to, what we've decided to do is finance the mine first. As soon as that's financed, then we'll finance and start construction at Salt End. So literally fully permitted, ready to go.
And finally, that is quite a substantial personal investment that you've put into the business. So I'm just wondering when you hope to get your daughter's inheritance back.
I think the reality is for these projects is that they have a cycle of around 5 years. And so if we take 5 years from now, I hope that we've constructed, commissioned, gone into full production, maybe even looking at an expansion. At that point, maybe some time to take some money off the table.
Lovely. Paul, thank you very much for your time. And yes, it was extremely helpful. Thank you. Take care.
Thank you.
Okay, so on to our next company now, and it's GreenRoc Mining. It's developing critical mineral projects in Greenland. Now it listed on AIM in September 2021, and the chief executive is joining us now. It is Stefan Bernstein. You're very welcome to join us. Thank you, Stefan.
Thank you very much, Sarah. And I will be speaking about graphite, graphite being one of the critical raw materials for the energy transition. And that is because it makes up the active anode material of lithium-based batteries, and therefore EV batteries, for instance. What you see here in this first slide is active anode material in form of spheronized graphite, produced from feedstock extracted from our deposit in South Greenland. So I will now explain to you how we are going to supply Europe's EV industry with this very critical raw material. So I'll jump through the disclaimers quickly. These numbers are all on our website. We are listed here on AIM, GROC. We are currently valued at 4.3 million, which is significantly lower than the value of the deposit that we are developing, as you will see in a moment. We have a series of projects under development in Greenland. The most important of them, and the subject of today's presentation here, is the Amitog Graphite project in South Greenland. So graphite, why is it important? It's the anode part of the batteries. And it also is by weight the most important single constituent of lithium-based batteries. More than a fifth of the weight of the battery consists of graphite. Therefore, in an average Tesla on the street today, you'll find something about 80 kilograms of graphite. And that graphite is not just any odd graphite. It's processed into what's called spheronized graphite, which you can see in the panel here in the middle, where you take the natural flake graphite. It's then reshaped into these minute potato-shaped rounded particles, a few micron across, and then it's purified and coated to make what's called coated spherical purified graphite, CSPG, or active anode material. And that processing capability is today situated in China and only almost exclusively China. So China, as I said, is processing all of the world's graphite, or nearly all of the world's graphite, but it also is a source of nearly 2/3 of the production of natural flake graphite and of synthetic graphite. Both of them are parts of the active anode material. So, of course, that is of concern with regard to having a secure supply chain to feed the growing demand from the gigafactories. And in fact, recently China announced that they are going to impose some export restrictions on battery-grade graphite as of with effect of December 1st last year. Right, so the demand for graphite is rapidly increasing over the coming years. It's estimated that over the next decade, it's going to grow by 400%. And that, of course, reflects the fact that the battery industry is hugely ramping up production in Europe and in North America with 30 to 40 new gigafactories being built and in production by the end of this decade. And therefore, you also expect to see an increased price of this very critical raw material in the years to come. Because obviously the biggest demand really here is in China itself. So in a few years here, we may see that the Chinese production is going just to feed the domestic market, leaving these gigafactories in our part of the world with the lack of supply of the anode material. So the supply chain looks like this. You have the mining where you extract your graphite, or it's processed into graphite concentrate that is then treated through micronization, spheronization, purification, coating to end up with active anode material that the battery cells are built from. So our business really addresses the entire supply chain here. The first block here, the mining and concentration, I'll speak about first, and then comes the processing part. The mining will take place in Greenland at Amitsoq, which you can see on this map is situated in the southern tip of Greenland, and therefore is enjoying, by Greenland standards anyway, relatively mild weather. The Amitsoq deposit is situated on the southern tip of this island here, about 20 kilometers north of Nanortalik town, which is the southernmost town in Greenland. You can see on this satellite image here that the Amitsoq deposit is surrounded by deep water fjords, and they remain ice-free year-round, and therefore provides easy access by big ships to right up to the deposit. Amitsoq was an operating mine 100 years ago, and that testifies, of course, to the viability of actually establishing a mining operation in this part of Greenland. It closed about 100 years ago because of falling prices after the First World War. It was drilled for the first time back in 2021, and then we had another second drilling campaign in 22. We identified two main ore bodies, and we have now also announced a resource estimate as of January last year of 23 million tons with more than 20% graphite. And it's important here to stress that we haven't yet reached the outer limits of the deposit, so it's open in three directions. And also under our license in Greenland are other deposits, satellite deposits, so we're really opening a world-class graphite district here. So these high grades here really puts us in the top league of projects under development worldwide today. You can see here in the green dot is the average grade of our deposit. In the blue bars, you see enterprise value per ton of contained graphite in ground, showing you that we are vastly undervalued. That means, of course, that a very good investment opportunity. I'll also stress here that Greenland is a good country for mining. It has a very mining-friendly legislation, also we have found a very supportive government, and even more importantly from the local population, that are all excited about seeing the opportunity to have the neighboring mine to reopen. So let me just so we announced the result of the preliminary economic assessment a few months ago. Showing that we have a positive NPV of about $180 million at 8% discount rate, and internal rate of return about 27%. Right, so that is the mining operation producing graphite concentrate. So if we were to be in production today, which we're not, it takes some time to develop, but if we were, we would have to export this graphite concentrate to China to have it processed. Obviously, it makes a lot more sense for the reasons we heard in some of the other presentations today, to have a processing taking place nearer either the mine or where the off-taker is located. And therefore, we are presently looking into setting up a processing plant to undertake this production of active anode material. To that end, we have conducted a series of test work on graphite concentrate extracted from Amitsoq ore. It's lab bench test work. It's undertaken by ProGraphite in Germany, but it went through all the standard procedures that you undertake to produce active anode material, and we were very successful in achieving a very high quality spheronized graphite product, also achieving the purity levels that are required. And very importantly here for this business case here is that when you take your graphite concentrate and go through this processing, which is of course a lot of effort, but you end up with the active anode material, which is what the gigafactories demand, then you're looking at a 5 to 6 times increase in value. So it makes a lot of business sense, of course, to build up such facility, knowing that we have quality feedstock to supply consistent quality during the production of the active anode material. And to that end, we are presently conducting a feasibility study for setting up such an active anode material processing plant. It will be concluded in Q2 this year, probably May. It is supported by a £250,000 grant from the UK Advanced Propulsion Centre. And by the end of this feasibility study, we will have a robust business case for setting up such a plant. And we are presently looking at locations in Northern Europe for the plant and in North America to address both markets. We are also having discussions with a variety of potential off-takers and industry partners in order to help us through these development stages. We have some potential off-takers that have demanded some samples of graphite from Amitsoq, and they have conducted their own test work, and the results they have been very pleased about. So all is good in terms of product quality. I will also mention that we received a letter of support from the European Raw Materials Alliance stating that GreenRoc's graphite resources of global importance, and therefore we are also expecting that will play an important role in the implementation of Europe's Critical Raw Materials Act, which was agreed on just before Christmas. So with regard to where we are today with the development here, we're really progressing along 2 paths here. The top one is getting towards the production of graphite concentrate from an Amitsoq mine, and the lower one here is setting up this production, or rather processing capability at a processing plant. The top one here, with regard to setting up the production, we have concluded most of the work towards the environmental and social impact assessments. We've done the preliminary economic assessments. We have some bulk sampling processing ongoing. So we expect by the end of this year to have submitted our exploitation application and progressing towards the PFS. Then we are waiting a DFS in 25 and then start construction 26, 27. And finalizing for a production start in late 27, early 28. With regard to the processing plant, we are well ahead now with the feasibility study. We will identify the sites for setting up for building the plant, and then in 25 we'll be looking at establishing a pilot processing plant, getting into the certification process and DFS, and then on to construction 26, 27. So when the first shipment of graphite concentrate goes out of Greenland, we have the plant ready to receive it at the other end. So that is the end of my presentation. Thank you.
Thank you very much indeed, Stefan. So you're having the conversation with the off-takers and the industry partners. The quality of the product has got the thumbs up. In an ideal world, you'd be starting production the second half of 2027. But Lee asks, why is the UK funding this when you won't be setting up a business in the UK?
So first of all, we are a British company. We're listed in the UK. Obviously, our hope is that we'll be ending up setting up the production in our processing plant in the UK. The grant from UK doesn't come with an obligation to set it up in the UK, but of course we'll be able to make this very important product available to the British car industry. Whether the actual processing plant is then being built in the UK or not, it's very much a matter of, well, what makes business sense, of course, but also where do we find the local support for building such a plant. But I think UK is definitely, with the very important car industry that was also mentioned earlier today, it's a logical place to be setting up.
Thank you, Stefan. And local support is a theme that is permeating through a lot of these presentations, and could possibly be one of the reasons why the EV economy isn't as smooth and as circular as it ought to be at this stage of its development.
Well, certainly, and that is particularly true for the extractive industries in Europe, that oftentimes you see that good projects are being killed quite early because of local opposition, or permitting being dragging on for years. This is not the case, and this is not what we expect to find in Greenland, where, as I said, we are receiving a lot of support, both locally and from the government.
Stefan, thank you very much indeed. Thanks for taking time out, and stay warm. Thank you. Right, ladies and gentlemen, we are going to take a 6-minute break. We're going to be back at 2 o'clock. If you can't bear to be parted from your screens, go to masterinvestor.co.uk and sign up for the Master Investor Show. It's the largest of its kind. It's Saturday, March the 9th. But if you do want to take a break from your laptops, we'll be starting bang on 2 o'clock. You've got 5 minutes. See you then. Right, hello, welcome back. That was a quick break, wasn't it? I actually had to switch the heating on after telling Stefan in the first half that I hoped he was warm. I certainly wasn't. I hope you are. Welcome back to this EV economy webinar hosted by Master Investor and the Small Cap Network. We've got 3 more companies to hear from this afternoon, and we're going to start off with Equipmake, which is engineering an electric future. Now, it listed in 2022 and its shares are traded on the Aquis Exchange. I am delighted to be joined by the founder and the chief executive, Ian Foley. A warm welcome to you, Ian.
Hello there. Hi. Okay, so I shall just share my screen and get the presentation up and running. Okay, right. I think we've got technical difficulties over. Okay, so so we're Equipmake. We're based in Norfolk in England, and we design and manufacture all of the key technologies required for electrification of transport. So that's motors, inverters, which is the electronics box that drives the motor, battery packs, etc. And we are in production with a global customer base. And crucially, we are vertically integrated. So we design and manufacture the whole drivetrain, but also we integrate it onto the vehicle. And well, why is that interesting? Why is that important? There's been a lot of talk recently in the press about the fact that the likes of Tesla and BYD are not only selling the most electric vehicles, but also making a profit, whereas the other large incumbents are struggling to make a profit. And part of the reason for that is that with the electrification challenge, the whole architecture of the vehicle has to be redesigned. Unless you're in control of all of the parts of that, then it will be it's much more expensive to have all the individual components from the individual tier 1, tier 2 supply chain. So as there needs to be a complete redesign of the architecture, being vertically integrated is really crucial to getting the most effective product and crucially making a margin. I'll come on to why that is in a little while. We were delighted this week to bring on board Nick Moulders as COO to join the team. He brings great experience from a company called Pensana, where he's been involved in taking technology companies in the electrification space from startup through to production. So he's a great addition for the team. Looking at the sectors we're in at the moment, we're focusing on the bus sector, but we're also in marine, aerospace, and performance automotive. Sometimes people might say, well, aren't you diversifying a bit too much? But the crucial thing is it's the same technology in all those sectors. And for sectors such as marine and aerospace, we partner. So we've got a philosophy or strategy of partnering with key companies in the different sectors. So we're producing the core technology, they're doing the sales and marketing. And when I talk about core technology, so this is some of our IP. So as I say, we design and manufacture the motor, the electronics box that drives the motor, the inverter, and that's really our core IP. And then there's a whole systems integration. So the integration of all those items into a product, which is the area that the majority of the incumbent industry is really struggling with. And that's an area which has led to us winning a number of global OEM customers that I'll come on to. And another example of why does vertical integration work? So our competitors are purchasing from tier 2 suppliers, motors, inverters, etc., at a high margin. They then need to make a margin on the end product, whereas we only have to make a margin once. If you look at something like the inverter on the bottom there, that's the electronics box that drives the motor. You need 2 of those to drive a motor of that size. We've managed to incorporate the 2 of them into one inverter, which is designed for our specific application. And this saves us huge cost. So basically, a combination of the fact that we are manufacturing and not purchasing at retail, but also we are integrating the exact specification for our requirements, means that we can, our core components are a fraction, probably 50 to 60% of the cost of our competitors. And this is a global opportunity. So we're already supplying as far afield as Australia for rocket motors, North and South America, and throughout Europe with customers such as Caterpillar Perkins, biggest tour bus operator in the world, First Group, the biggest bus operator in the UK. And within buses, that's our core business at the moment, where we've got 2 opportunities. We are partnered with the company on a new bus, but there is a huge opportunity for us in the repowering of existing diesel and hybrid buses. So repowering means to get a bus which is probably about 7 years old. A bus lasts about 15 years, taking out the diesel engine and gearbox and fuel tank, replacing that with an electric drivetrain. So typically for the customer, it's about half the price of a new electric vehicle. And we can see there our repowering site in North Norfolk, which is full of vehicles at the moment being repowered for the UK market. But repowering is also a global opportunity. We're having discussions with numerous companies in the US. If we look at the yellow school buses there's 470,000 yellow school buses in the US. There's about 80,000 transit buses. One of our competitors, C Electric, recently won a $100 million order to repower 1,000 of those. So huge opportunity globally. We are currently looking at the US, but in the UK, where there's 5 different funding regions, we're already well advanced with repowering in the UK. But we're not just repowering, so we also have an OEM business. We supply systems for new vehicles for Emergency One, which is the largest fire truck manufacturer in the UK with an 80% market share. But through that company, we're supplying Rev Group, and the truck you can see on the top left there is an American fire truck, which is currently in production. The whole system's supplied by Equipmake. But also there's other special vehicle manufacturers such as airside special vehicles on the bottom left there, or port trucks. So we already have 2 global OEMs in those fields as customers. And we also have a growing aerospace base. So we supply rocket fuel motors for a company called Gilmore Space in Australia. And we've also been the supplier for the prototypes for an eVTOL company called Vertical Aerospace in the UK. But our most exciting aerospace opportunity is with a company called H55, who's developing a drivetrain. We are the motor supplier, and this product will be the first fully certified, fully commercial electric aircraft in production. There has been an aircraft by a company called Pipistrel. The Pipistrel was bought by Textron. That was a microlight aircraft. But we are part of the program, partner in the program for the first fully certified, fully commercial aircraft, and that will be in production in 2025. And then another area where we are active is in the ultra high performance automotive market. We're a supplier to Rimac Automobili, company which is 50% owned by Porsche and produces the fastest electric supercar in the world. We've got a multi-year contract to supply the front inverter for that vehicle. And then lastly, in marine, we also are partnered with a company which has produced a foiling electric boat, which has won multiple records in the last year. So again, the same core technology, our core technology of motor, inverter, and drivetrain integration is applicable to multiple industries where we are already active. So as a result of that gives us a fantastic growth opportunity. There's an illustrative revenue split there, which actually shows repowering tailing off. We don't believe that repowering will die away by 2029, but our strategy is to work with more partners to do the physical repowering while we supply the core drivetrain components. But we've also got a large license opportunity, and a really exciting opportunity for us is that we've partnered with a company called Sony Comstar. Amongst others, Sony Comstar make 2 million low voltage motors a year for starter motor and alternator applications with customers such as GM and Ford outside of India. They've licensed our technology for manufacturing for the Indian bus market. There's huge growth in that market. The Indian population, I think, has already exceeded China. The bus market's going to be bigger than China, and so we will be in production with Sony Comstar within the next year. But one of our most exciting opportunities has been chosen by Perkins, which is a wholly owned subsidiary of Caterpillar, the largest OEM, off-road OEM company in the world. And for this project, we are developing a bespoke motor and inverter that will go into a zero-emission off-road drivetrain that will be a hydrogen-powered engine, but with an Equipmake motor and inverter as the hybrid elements of that. And Perkins currently manufacture 200,000 diesel engines a year for these applications at their site in Peterborough. So you can make your own guess how many of those are likely to need to be zero emission in about 5 years' time, but a significant proportion of them. In terms of our current size, we turned over 5 million last year. We're growing rapidly. We expect to exceed that significantly this year. We've got an 11 million order book currently, which is growing all the time, and currently loss-making, and we will turn that around in the next year or so. That gives an example of our current shareholder base. And we've made significant progress since the IPO in the last 18 months, where we have buses delivered and running for First Group, biggest bus operator in the UK, license agreement signed, supplying one of the largest airside vehicle manufacturers in the world, and the Perkins contract that I just mentioned. And then lastly, we were delighted to get a testimonial from First Group in York, where we've delivered vehicles into their pool, and they're telling us that the availability is the best of all the vehicles they've got, which is a fantastic testimonial for us. So yeah, so that's the end of my presentation. Thank you very much.
Thank you very much indeed, Ian. And you talk about testimonials there. Now, I understand from doing my research into you that Caterpillar, who are associated with Perkins, which is this deal you're very excited about, I think Caterpillar did a 12-month due diligence on, or not you personally, but the company. And so that in itself is sort of the Caterpillar credential, sort of hallmark, isn't it?
Absolutely. I mean, they needed to be sure that that our technology was appropriate and the best. I think the thing was there's an awful lot of companies of our size who are on the road to productionization, but we could demonstrate an existing production capability that gave them the confidence that we were going to meet their targets for 5 years' time. But it's a fantastic testimonial. But similarly with Sona Comstar, I mean, they manufacture 2 million motors and inverters a year, and they needed to be sure that in licensing the technology, we had something that was able to be productionized at volume. And that's the other critical thing for us, is we're developing very high spec product, but designing it at the start to be able to be productionized at volume.
So I was thinking about all those yellow school buses in the US, and then I was thinking about the population explosion in India, and how education is very, very important there as well. I'm just wondering about the growth potential. So are you targeting the US first and then India, or both concurrently?
So the great thing about our partnership in India is that we're licensing the IP, so Sona Comstar are doing the heavy lifting in terms of actually developing that market and the product, and then we will get a license fee from it. We are really excited about the US opportunity, where we had a UK focus, but we've been approached by multiple companies in the US. Having researched the opportunity from a market size and a margin point of view, it looks like it can rapidly accelerate our business. But again, our strategy is to find the right partners. So we're actually supplying the core components. We'll have a partner in the US to actually do the repowering.
And very finally, because you did skip over that particular slide, it's worth reminding the audience that you have got significant skin in the game, if you want to remind people about the percentage of shares that you hold.
Yes, it's just under 40% at the moment. So I have got, as Jim Slater would have said, an owner's eye. So significant skin in the game, and yes, hugely important to me that we are generating returns for shareholders in the shortest possible time frame.
Many thanks, Ian. It's been a pleasure. Thank you. Do take care. That was Ian Foley of Equipmake, and we're going on to our next presentation, which is Trident Royalties. Now, it is a diversified mining royalty company, and it's growing quickly. It's dual listed. It's on AIM. The market cap currently is £109 million or thereabouts. I'm delighted to be joined by the Chief Executive, Adam Davidson. Good to see you again, Adam.
Hi, good afternoon. Let's see, I'm just sharing my screen now. Hopefully everybody can see that. Standard disclaimer, and I should flag that this is the same presentation effectively that's on our website. And in fact, we've got a little bit more content on our website, but did a slightly abbreviated version for this presentation. As you said, Trident Royalties, so we're a mining royalty company. I'll explain what that is exactly in a moment. But the quick background on the companies, we listed on AIM in mid-2020. At that time, we listed at 20p a share. We're kind of hovering around 35 at the moment. We listed with one single royalty. We've now got 21 assets, a total of 13 of which are cash flowing across a broad spectrum of commodities with a heavy bent towards EV battery metals exposure. So the quick background on what exactly is a mining royalty, it's not dissimilar from royalties in other sectors. Most people are more familiar with music royalties or movie royalties. And in those situations, obviously the artist is paid when they sell an album or when a movie is played. In the case of a mining royalty, it's not hugely dissimilar. We effectively are financial instruments, and they entitle us as the royalty holder to a cut of revenue from the underlying operation. So they typically range anywhere from a 0.5% to 2%, but they can really be any number. And effectively, the type of exposure that they offer is slightly different from mining equities, or in fact investing directly in the metals themselves. The biggest thing is because we're getting top line exposure. So when an operation sells the material, generates revenue, we get a percentage of that revenue. Whereas equity exposure, obviously you're getting bottom line exposure, where you have to have the operation in profit for equity to be making a return there. A royalty is different in that we get a cut of the top line. It's much more stable in many respects. All things being equal, if production's equal, you're effectively just directly exposed to the commodity price rather than exposed to operating costs and capital costs of the underlying operation itself. And then relative to physical commodity ETFs or other instruments that will give you just sort of physical metal exposure, the reason people invest in mining equities is because I think it's 80+% of all mines that are built extend their life or expand their planned production profile. That's the reason people invest in mining companies. You want that asset level upside exposure. So we kind of get the best of both worlds. From a protected instrument that's not exposed directly to operating costs of the mine, we get that asset level exposure. But then we're also hedged such that we're getting primarily the metal price exposure, and doing so via an instrument that in most cases survives bankruptcy once it's pegged on the land. It's on that property in perpetuity. In most cases, it can't be diluted. Importantly, so whereas many miners have to raise equity to fund expansions or to build their projects. If a royalty's on a property, it's that number, and it's there forever. So a very attractive instrument and a good way to get exposure to the mining sector. Taking a brief look at our portfolio then, as I said, we built it out from one asset at inception to 21 now. We added a total of 5 assets last year, 4 sort of significant size ones. 13 of our assets are cash flowing, and importantly, over 60% of our net asset value per analyst consensus estimates is in Canada, US, and Australia. Yeah, we've got some assets further afield in South Africa and Zambia, for example, but we want to keep the bulk of our exposure in developed jurisdictions for a couple of reasons. Obviously, the geopolitical risk angle, but also the legal framework for royalties is usually better. Ensuring that the royalties survive bankruptcy and some of those attractive features that convey with them. The other thing to flag on this slide is we flag them as select royalty partners, but these are the operators of the assets. And often it can be assumed that because we're a junior royalty company, that all of our royalties are over junior-led projects and therefore are sort of higher risk when commodity prices move through the cycles up and down. When in fact, it's almost the exact opposite is true. The bulk of our royalties are operated by mid-tiers, or in a couple cases majors, and we do have some juniors as well, but the likes of Lithium Americas, a couple billion market cap, Equinox Gold, similar, Mineral Resources, 8 billion market cap. So good, strong operators with strong balance sheets. The bulk of our royalties were acquired from third parties that had these royalties on their properties, predating these mid-tiers taking acquisition of the properties. So in most cases, we're not providing finance to these operators. We're buying them from third parties that have held legacy royalties over the properties. And you'd be amazed how many of these things there are. That there's literally thousands of royalties out there in the world. So sifting through them, finding the ones that have meaningful value and near-term cash flow, and then acquiring them on an accretive basis is really the bread and butter of our day-to-day business. You can see our revenue profile here. This is again per consensus estimates. I like to flag here that the sort of gold part of the bar is assets that are currently in production. And so we see a step up in revenue over time as assets are a couple are in ramp up, so they're increasing their production profile as they approach steady state. And then the light blue is predominantly driven by assets that are currently in construction or have very near-term revenue. You know, I'll talk to one of our assets, Thacker Pass, in a moment. The major lithium asset, it's in construction. The operator spent nearly $100 million in construction just last quarter. So I guess really what we're trying to underscore here is that many companies show a revenue growth profile that has sort of a hockey stick characteristic to it. But on ours, we believe that it's very tangible and that it's largely driven by assets that are either producing today or are in construction today. And on to kind of the EV style exposure that we're providing via royalties. You can see the commodity breakdown of the portfolio as we stand today. When we first listed, we just had a single iron ore royalty. It now makes up less than 2% of our NAV. The bulk of our net asset value is in lithium and spread across a few assets there, followed by 30% in gold and then 20% in copper, and then silver and then a smattering of other commodities. Yeah, I think one of the competitive angles of Trident is the mining royalty sector is not tiny. It's in aggregate about 70 billion in aggregate market cap. And yet only a very tiny portion of that, a couple billion, is focused on non-precious metals. The bulk of our peers are focused on gold royalties. And effectively, they're a gold derivative trading instrument for many investors. And that's a nice exposure to have, but it leaves open a big chunk of the mining sector. A full 2/3 of the mining sector is not precious focused. It's base metals, increasingly battery minerals, and that's really the area we're focusing on. We will do gold royalties when we can find value, when we're not competing with the 20-odd gold royalty companies. And incidentally, we've found a few more than we probably expected. Hence why our gold exposure is 30%. That's largely driven by one larger transaction. I think as time progresses, we'll see that gold exposure start to whittle down a little bit as we add more base and battery metals. Just looking for a second at lithium. This is a commodity that we're very pleased to have gotten good exposure to. You can see on the left side a couple of the charts. You see this exponential growth in the uptake in EVs and hybrids. And I'm sure you all have heard some of the aggressive targets out there. I think 50% EVs and hybrids is the current U.S. administration's target by 2030. California has a mandate for 100% by 2035. I think we all anticipate these targets will move around, they'll flip, all those sorts of things. But I think the general trend is pretty undeniable. Yeah, I don't expect that these numbers flatline from 2023 in perpetuity. I think we continue to expect to see that level of growth. And I guess the reason we like lithium so much as a cornerstone of our portfolio is when you look at the lower charts of the battery chemistry of all types of the key batteries being used in EVs, lithium is a core component. You know, there are battery designs that have engineered out nickel. Others have engineered out cobalt or are reducing it given its scarcity. Some don't use manganese, but they all effectively use lithium. So it's a commodity we very much like having exposure to. And then the next natural question is how do we have exposure? So I'll talk to Thacker Pass. Just given the shortness of time, I'll only talk to this asset, but again, I point you to our website. We've got loads of material on all of our assets. But Thacker Pass is our biggest asset on a NAV basis. Depends on the analyst lithium price assumptions, but probably around 25% of our total value. it truly is a tier 1 asset in a tier 1 jurisdiction. It's in Nevada, in the U.S. The U.S. effectively doesn't produce much domestic lithium at all. It's all imported. It's flagged as a critical mineral. Particularly in this macro environment, there's a real push for security of supply. Both of the recent administrations have been supportive of this project, both the Trump and Biden administrations. And we bought this royalty back in 2020 when the asset was sort of moving towards construction. You fast forward to today, it's now finalized all of its permitting. In the U.S., as you can imagine, permitting is a lengthy, decades-long process. It completed that around this time last year. General Motors has bought in, putting in $650 million, be the largest shareholder of the operator. They'll have all the offtake of stage 1 production. It's the biggest investment by an automaker directly into the battery metals extraction. It's a globally significant blue chip asset, 40-year mine life with plenty of scope to extend that life or expand production. We picked up the royalty for $28 million in 2021. At $25,000 lithium price, it would pay us about $21 million a year once fully ramped up. At the high lithium price last year, would have been paying us sort of $70+ million a year. Lithium's got that scope for continued volatility as it's not an exchange traded commodity and it's in this sort of growth period. There will be years of really outsized return over that 40-year life. We were originally pricing in a 16% post-tax IRR. Mid-teens is generally our target. Again, we were using a $12,000 per ton long-term lithium price. That's increased over time to about $21,000 per ton. The planned production profile increased by a third, which again highlights the benefits of royalties. Initially on the pre-feasibility study was a $550 million project. They increased the planned production profile, add in some inflation, and now it's a $2.3 billion project. Now it's being built, so we don't have to worry that won't be financed. But from our perspective, we get just over 1% of their revenue. We get that in perpetuity. We can't be diluted. The cost of the project, that doesn't impact us whatsoever. In fact, the fact that they made it a bigger project is very beneficial for us because that means more production equals more revenue. Just flipping forward to copper, we do have some good copper exposure. It's a commodity that we're very bullish on. We've got one producing copper royalty. It's already paid back the deployed capital that we put into it. And then our most recent acquisition in November was a copper royalty in the U.S. A good project that's on the cusp of releasing its pre-feasibility study. So moving pretty aggressively through that development cycle to get to a construction decision. The final slide here is just to flag our balance sheet. We recently announced a revolving credit facility with a couple of the big commercial Canadian banks, BMO Capital Markets and CIBC. That'll be a $40 million facility, revolving in nature, such that we can draw down on it to make acquisitions and pay it back and draw down and repeat that process over and over. And that's really the way that most of our large gold-focused royalty peers have grown their business. It avoids equity dilution by being able to tap into credit facilities to expand the portfolio. So we're really pleased to get that, and it's much lower cost. Sort of depends on leverage ratios, but kind of 2.5% to 4.5% over SOFR, and we expect to be on the lower end of that range. So well funded with a strong balance sheet, 19 million in cash, most recently reported number, and good institutions. For the UK market, the ones you'd be aware of, the Ruffers, the Maudis, BlackRocks of the world, very supportive shareholder base. So for us, I think we're through the proof of concept phase. We've built out the business over the last few years. And now as we're on the cusp of seeing our revenue really start to tick up and we continue to add new royalties, we think we're at a very exciting period for the business. With that, happy to pivot to questions.
Many thanks. And that's another very good looking shareholder register, just like the previous presentation made by Equipmake. So yes, there are a few questions. Olin asks, mining royalty, a bit more detail, please, on protecting downside if the mine goes bust.
Yeah, that's a good one. I think a key thing for us, obviously, in our diligence is to make sure that we're getting royalties over defensive assets that will survive the commodity cycle. So in an ideal world, those are assets that are in the lower half of the cost curve. meaning that half the producers are higher cost than they are, such that the price has to dip, and you need to see quite a few operations shutting down because they're uneconomic before the operations that we have royalties over shut down. Yeah, a good example of that, just because I spoke to it, is Thacker Pass in their final study released about 11 months ago. They flagged $6,700 per ton cost of production. So that's a very competitive cost structure. But I suppose the other thing is just the inherent value in royalties themselves. As I said, they do typically survive bankruptcy. Depends on the jurisdiction, the legal framework, but most common law countries, they survive bankruptcy. So there are instances of when an operator either gets into balance sheet troubles and shuts down, or the commodity price dips and the operation is idled. Unlike equity, which may get really dinged or wiped out in those scenarios, the royalty sits there patiently, and there are many examples of royalties turning back on as a new operator takes over or the commodity cycle turns. So it's not 100% protected in that if you get a royalty over an uneconomic mine, that's suboptimal, but it is better protected than equity.
Okay, Paul asks, is uranium now on your interest radar?
It is, and it always has been. I've done a lot of work in a previous life in uranium, as has one of my colleagues. So we've always been on the hunt for good quality uranium exposure. It's something we would like to add to the portfolio. Yeah, as a flag, when we first launched this vehicle 3.5 years ago, we had just that single iron ore royalty, which is now less than 2% of our NAV, and we've been pretty aggressive about building out the portfolio. That's going to be a constant work in progress, and certainly have uranium on the list.
Dividends, how likely are they to be incorporated into the business model?
Yeah, I think we're all conscious that the UK is a very yield-focused market, and this model very much lends itself to being a dividend payer, in the sense that when you look at our biggest peer in the space, they're 25 billion market cap. They've got less than 40 employees. The fact is, we're not operating mines. We've got 6 employees. We're acquiring these financial instruments over mines, and then you put them effectively in your back pocket. You have them audited, when they're in production every so often, but you're out there looking for new acquisitions effectively thereafter. So it's a very scalable business. Our G&A it depends on how busy we are and how much we're paying lawyers and consultants in making acquisitions, but call it 3.5 to 4 million, and then debt service kind of depends again how much we've drawn on the revolver, but for this year, probably 2.5 to 3 million. Yeah, and we're kind of on track to deliver 11, 12 million in revenue for 2023. So royalty company financials are really hard to follow because we're obviously using amortization to drive down the tax bill. And we can offset the purchase price of a royalty against tax. So I always point people to cash flow, and on a cash flow basis, we're a cash flow positive company, and each incremental dollar as that revenue ticks up flows straight down to the bottom line. So you can see as these assets turn on, and particularly assets like Thacker Pass turn on and are fully de-risked at that point in time, that's a pretty clear time where we'd want to commence the dividend, and really our objective is to pull forward that date by acquiring more royalties.
Okay, we've got 30 seconds left. 2 questions. Where do you see yourself in 5 years' time?
I'd like to see the diversification built out more. I'd like to see nickel on here, uranium. I'd like to see the full spread of commodities such that investors can get exposure to Trident. By a single share of Trident, I've got, via the best type of financial instrument, I've got exposure to the entirety of the mining commodity sector. That would be the ideal outcome.
And David asks, very competitive business. Are you having to lower your bids on royalties to compete?
Well, in the current market, it's actually a great time for us to make acquisitions, which is why we made so many last year. We're not immune to the softness in share prices. Our share prices come off a bit here recently as well. That said, we're well funded, so we've seen the miners getting dinged even more aggressively. So they don't want to go out there and raise equity. They're open to royalty financing, whereas in a more buoyant market, they tend to not like royalties because, as I said, they're there in perpetuity. They can't be bought back. They're a fixed instrument. So yeah, for us, it's a really good time to be deploying capital. And as I said, our new revolving credit facility actually lowers our cost of capital at a time where most operators' cost of capital are increasing due to inflation and interest rates. So we're really in a good position at the current moment.
Adam, thank you very much indeed. Really appreciate your time. And thank you, the audience, for some cracking questions. Okay, we're on to our final presentation of this event. very sadly. Now, mining in Cornwall, when do you think it started? Well, it started in the early Bronze Age, think over 2000 years BC. Well, let's fast forward to 2024 and find out about Cornish metals and its proposition. We're going to hear about that from the Chief Development Officer, Fauzi Hanano. Fauzi, thank you very much indeed for joining us.
Thanks for the introduction, Sarah. And I'd like to thank everyone attending the call today. I'd like to provide an introduction and update on Cornish Metals and our South Crofty tin project located in Cornwall. I'll take this disclaimer slide as being read. So firstly, Cornish Metals' mission statement is to bring responsible tin mining to Cornwall, which would be benefiting the region, which was, as you just mentioned, has a long history in mining, which has unfortunately come to an end over the last 20, 30 years, and also to provide a local sustainable supply of tin, which is a critical metal for the energy transition. So tin is not a very well understood commodity and tends to be overlooked. So I'd like to spend a few minutes just on this. Many associate tin with some of its more traditional historical uses, such as alloying or tin plate. However, individually, these account for very small end uses for tin. In reality, as you can see on the chart, about half of tin consumption is used as solder. Tin connects almost all electronic and electrical infrastructure. Other uses also include batteries and solar panels. The energy transition is the biggest long-term demand driver for tin, and tin is a commodity that may be the most positively impacted by new technology because of its use across the wide spectrum of anything electronic. While tin is used in pretty much small quantities, if there is an electrical connection, tin is used. It's in all circuit boards, in our laptops, mobile phones, for example. Tin consumption per EV is about 1 kilogram, which is about twice that used in internal combustion engine cars. And that's as a result of increased electronics in cars, not just in EVs, cars having more active safety and whatnot. And then you go into EVs, there's even more electronic requirement in there, which increases the use of tin. Tin is designated a critical metal in the US, Canada, UK, of course. There's no mine tin production in North America and no primary production in Europe. So security of supply is clearly a concern. The majority of production, as you see here lower on the slide, which is from Asia, and that accounts for about 70% of mine supply and over 80% of refined production. So that is quite an alarming figure. And most of this comes from 3 countries, China, Myanmar, and Indonesia. Recent supply issues that we've seen linked to government policies in key tin producing countries, such as Myanmar and Indonesia, highlights the security of supply concern. And looking at the longer term prospects for tin, it's expected, demand is expected to grow by nearly 30% in the next 10 years. But we don't expect supply to be able to keep up. So it's expected that there will be growing market deficits coming on from later this decade. Our South Crofty tin project can play a role in bringing new supply to the market and become a local producer of tin, which makes it a strategic asset in the UK. It's a high-grade asset, being the 4th highest grade in the world and highest grade non-producing tin project. It's been in production for over 400 years. It started in 1592 and stopped operating about 25 years ago. The reason it stopped is not because the asset ran out of tin, but rather because of the depressed metal prices. Tin prices collapsed in the mid-1980s, and most hard rock tin mines stopped producing as a result. South Crofty kept going for another 13 years. Up until 1998, which is testament to the high grade and low cost nature of the mine. South Crofty is fully permitted and has existing mine infrastructure, which is very, very beneficial. And there will be no surface waste, with all tailings to be backfilled underground. Here you can see a view of the South Crofty mine, which is the blue-purple area in the middle. The image points to a long history of mining over hundreds of years and more in the Camborne Red Ruth region, as seen by the large amount of shafts, which are the yellow lines scattered all over this image. A lot of which is in the shallower sedimentary rock that hosted high-grade polymetallic mineralization of copper, tin, and zinc. There's a lot more resource growth potential in the deeper granite that hosts the South Crofty high-grade tin. As you can see, it's a lot less shafts going into the deeper regions on this image. In September of last year, we released an updated mineral resource estimate for South Crofty. This produced a nearly 40% increase in tons in the indicated category and over 30% increase in contained tin. As you can see from the image on the lower left part of the slide, we believe there is potential for significant further resource growth at South Crofty with a deposit open in all directions. As such, we see potential to materially raise the current resource of about 5.5 million tons. But it's not just South Crofty. We see potential exploration upside elsewhere, and we're currently drilling at the nearby wide formation target, which lies, if you can see on the image here, that kind of blue area in the image, which is only about 1 kilometer south of the South Crofty infrastructure, which is this little area in the middle of the image. A previous drill program that we completed a couple of years ago returned an intersection of nearly 3 meters at 1% tin, and that was a discovery hole of this target. We are currently about halfway through a 9,000 meter drill program with 2 drills on site. The wide formation mineralization structures have been intersected where expected from the holes that have been drilled to date, so that is quite a positive. And we believe that the wide formation is potentially a new district size mineralization that lies beneath and parallel to the Great Flat Lode, which you can see here, the top red line, which is a zone that has been mined in the past. So the wide formation, which is the 2 parallel lines lower on this image, we believe it has a potential not just to extend the mine life at South Crofty, but also to increase the throughput of the South Crofty project. So in terms of current activities, the Cornish Metals team has been very busy in 2023, achieving numerous important milestones, and we expect this to continue in 2024. As I mentioned before, we updated the South Crofty mineral resource with a significant addition in tons. We've built and commissioned the water treatment plant, which you can see on the top right of the slide. And dewatering of the South Crofty mine is well underway, with water levels down now to about 260 meters below the surface. The metallurgical drill program was completed last year, and we've also seen very positive results from the ore sorting tests. You can see this image here with a red machine from Tomra. That's an ore sorter that was used, where it returned about a 50% waste rejection with only 3 to 5% metal loss. This will have expected benefits towards the capital and the operating costs of the process plant. The feasibility study is underway with many components completed. And just this morning, we announced that we plan to publish a preliminary economic assessment for the South Crofty project in the first half of this year that will provide an interim guidance ahead of the publication of the feasibility study later on. This here is the indicated timeline. We're targeting end of 2026 for first tin production. Key areas are dewatering of the mine, completing the feasibility study, and construction of the process plant. So in summary, we believe Cornish Metals presents an attractive investment opportunity. We wholly own the South Crofty project. It's a high-grade, high-value project. It's fully permitted, benefits from existing infrastructure, as well as having strong community and local government support. There's a lot of operating history, so we have very good data about mine processing, recoverability of the ore. There's significant potential to grow the resource base at South Crofty, as well as at nearby targets. This is going to be a very low impact underground operation with no surface waste. We have Vision Blue Resources as a strategic investor in Cornish Metals, They have a 26% stake following a £25 million investment made in May 2022. And lastly, tin is a critical metal that is essential for the energy transition, and South Crofty presents an opportunity for domestic tin supply to the UK and Europe. So that's the end of the presentation. Thanks for your time today. And if we have any time remaining, I'm happy to answer any questions.
Fauzi, we do have time remaining. Now, when I was doing my research yesterday, I was listening to one news outlet, and they were talking about more warmer, wetter winters and more ferocious storms due to climate change. So I was just wondering, how will that impact dewatering for the life of mine, if this is to be the case?
Well, we don't think that should have much of an impact. Now, we currently have the water treatment plant that I showed earlier. I'll go back to that slide to show the image where you see three, as you can see here, there's three parallel streams that are running, each of about 8,500 cubic meters. Based on historical data, the average water ingress into the mine is about 6,500 cubic meters. So only one of these streams is more than sufficient to keep the water levels at the level that they are at. Whereas the other two are used to dewater. We actually, incidentally, during the Christmas period, as most who stayed in the UK would know, had a significant rainfall, especially in the Cornwall area, and that despite that, we see the water levels having dropped to levels that are lower than had been projected. So we're quite confident that we will be able to dewater the mine within the 18-month period that we have guided. And during the operation of the mine to keep it dry.
Very good, Fauzi. Understood. Paul asks, when do you anticipate first release of wide formation drill results? And when did the first samples go into the lab for analysis?
So this is a 9,000 meter, about 14-hole program where, like I mentioned, close to halfway through. We would expect in the very near term to release the assay results for a good number of the hole that would have been returned. Can't answer with certainty exactly when the first samples went into the labs, but that would have been sometime in Q3 or Q4 of last year.
So I think people are assuming that you've got encyclopedic knowledge, Fauzi, because Sat asks, how does your cost base compare with China and Indonesia?
Well, what I'd highlight here, we are completing a PEA that will be coming out in H1 of this year. So I'll not refer to figures that were published in our last PEA that was several years ago in 2017. But the expectation is that South Crofty will lie well within the low part of the cost curve, of the global tin cost curve, given the high-grade nature of the deposit. And we do have historical processing data that demonstrates this. Looking at the PEA from 2017, it indicated an all-in sustaining cost of close to about $10,000 per ton, which is very low. It's something that's being currently updated for the new PEA, but we are quite confident this would remain a very low-cost operation.
So Fauzi, local support has been a theme throughout this entire webinar. And right at the end there, you said you had sort of local government support, but what about sort of residential support, the potential work pool that will be hopefully working at South Crofty? What about local support? Is that as engaged as local government and local administration?
Very much so, if not more. We're constantly engaging with the local communities, and there is a lot of support for the South Crofty project. Of course, there's history. Is the project that has been operating for quite some time. So a lot of pretty much you could cross many people on walking down the road who either know about the project or know someone either related or a friend who had been working there in the past. We actually have someone on our team, and one of our board members, actually one of our directors, was the mine manager and shut off the valves when the mine was closed in 1998. So there's a lot of history there and a lot of support, and we do a lot to engage with the local community. We're also proud that out of our 55 personnel currently at site, all but one are local to Cornwall. So we do make sure that we employ as much local talent as we can. Cornwall, mining is not new to Cornwall. We've got the Camborne School of Mines with a lot of expertise that have come through, graduated from there, and found themselves in other jurisdictions, getting mining experience. And we believe we could be able to attract some of that expertise back into the region.
That's wonderful. It's very familial. Thank you very much, Fawzi, for your time. It was a lovely way to end this very interesting webinar. Thank you very much.
Thank you, Sarah.
Thank you, and thank you, the audience. Right, so thank you to Fawzi, Emily, Paul, Stefan, Ian, Adam, to all the teams at the Small Cap Investor and Master Investor. Do check out the Master Investor website. Well, in fact, both websites, but I'm going to plug the Master Investor show at the Business Design Centre in London on Saturday, 9th of March, which as of today is a glorious 50 days time. So you've got plenty of time to sign up. Thank you very much indeed. Do take care and stay warm. I'm going to have to put the fire on now. Take care. Cheerio. Thanks.